Hey everyone, welcome and thank you for joining the investor presentation today. VY Capital Group is partnering with Dynamo Capital, and I'm extremely excited about this private real estate debt fund. This fund is providing hard money loans and DSCR financing to real estate investors in select Midwest markets, particularly in Wichita, Kansas and the surrounding region. These are high growth markets with significant lending opportunity and a major liquidity void. The reason I'm partnering with Dynamo Capital on this fund, and while I'm specifically love this investment, is because it's positioned in a high demand, supply constrained market where institutional lending is virtually non-existent and repeat borrower rates are among the highest in the country. Dynamo is providing best-in-class lending solutions to experienced real estate investors in a market where lending options are severely limited. With Dynamo's proven track record and conservative underwriting standards and extremely competitive terms, the demand fundamentals are exceptionally strong, and the fund has a proven track record with a 32.68% return in 2024 and the highest market share of any private lender in Kansas. The structure is designed to maximize investor returns by sharing origination fees, which is something most debt funds keep entirely for themselves, so they stand out amongst the rest. I'm excited to walk you guys through this opportunity, so let's go ahead and dive right in. Let's first start with a few introductions. My name is Brian Roth. I'm a fund manager at VY Capital Group. I'm both an active and a passive real estate investor with over 2 decades of experience as a real estate investor. I'm also an airline pilot flying commercially for the last 20 years. My wife, Gina, is also a fund manager here at VY Capital, and she has a background in finance with a BBA from Texas A&M University with a commercial lending background for a little over 10 years, and she's spent the last 13 years as a top producer real estate agent. Currently, I'm still an active landlord operating a $4 million rental portfolio, but Gina and I have shifted over to primarily doing passive real estate investing in debt funds starting earlier this year. So with that, we're going to talk about just a little quick disclaimer here before we get into the details. So this is the disclaimer slide. This is a 506c offering, so all the investors must have a pre-existing relationship with myself or Gina. The deal is not available to the public. You can share this opportunity with friends and family. However, we do need to have a one-on-one conversation to ensure that they qualify to invest. All right, so there's the second disclaimer slide, and we'll move on. So I'm going to start today with the high-level executive summary of the investment opportunity, followed by some basic private lending 101. I know not everybody has a background in this stuff, so we'll start with the basics and work our way from there, explaining what a private debt fund is, how it works, and why investing through a fund like Dynamo provides better diversifications and returns than a direct one-on-one private lending. Then I'm going to pass it over to Justin and Matt, the co-founders of Dynamo Capital, who will walk us through Dynamo's end-to-end lending solutions for borrowers and show us a real-world case study out there in Wichita. The Midwest market opportunity, we're going to talk about that, specifically the massive liquidity void that Dynamo is filling. We're going to talk about risk management and how Dynamo handles defaults and foreclosures, and how Dynamo achieves such high returns. I know that's the big question everyone asks, so we're going to dig right into those details and break down the numbers for you. And then finally, we're going to cover next steps if you're interested in learning more or investing in the fund. All right, so let's dive into the key details of the Dynamo Capital investment opportunity. So VY Capital Group, we've created a VY Dynamo One SPV. So that's the investment vehicle where we're going to pool our capital together to invest in Dynamo Capital's private lending debt fund operating out of Wichita, Kansas, and the select Midwest markets. So what Dynamo does. So Dynamo Capital does 2 core lending products. They do short-term loans, also known as fix and flip loans, ground-up construction loans, and bridge financing. And then the other product is a DSCR loan, which is a long-term loan. It stands for debt service coverage ratio, and that's for income-producing properties. It's a permanent form of long-term financing. A debt service coverage loan is basically they take the rental income, and it's a ratio of that to the mortgage or the debt service. All right, so this end-to-end solution is a huge competitive advantage. Most lenders only do one or the other, but Dynamo handles both of these seamlessly. And that basically allows like a fix and flipper to fix up a rental property and then keep it as a rental and just transition with Dynamo. They just originate a new loan with Dynamo there and go into the DSCR loan. So it's pretty seamless. All right. So investment terms for investors, we're targeting a 16.8 to a 18.9% annual return. The minimum investment is $100,000 and you'll receive monthly distributions on that. You'll have the flexibility to take full cash distributions, reinvest everything, or do a combination of both. So a little bit of flexibility there is pretty nice. There's an initial 2-year lockup period, and this investment will also generate a K-1 for tax purposes, and it's limited to accredited investors only. Dynamo is currently managing a loan portfolio of over $46 million and growing. And their recent performance, as you know, gets pretty exciting. I said it earlier, but we'll probably hear it several times throughout the video, but they generated a 32.68% return for their LPs in 2024. So very impressive. And that's actual cash that hit investor bank accounts net of all fees. So these are strong, consistent returns in a market where cash flow is increasingly difficult to find. As those of you probably know that have tried to buy rental properties in the last few years, that's just not existent really, cash flows are pretty tough to come by. All right, so here's why this opportunity really stands out to us and out from other debt funds. Dynamo has some serious market dominance. They have 13.5% market share in Kansas. That's the highest of any private lender in the whole state. And they're not just competing there, they're basically dominating that whole market. And it's also virtually no institutional competition there in Wichita or all of Kansas, really. It's a liquidity void that the Midwest has. It's a massive capital gap, while the coastal markets like California and New York are flooded with these types of lenders. Dynamo operates in markets where institutional lending is really non-existent, and this gives them a tremendous pricing power and deal flow. So they've got more deals than they have capital to deploy, and so that's why we're here raising money today. This end-to-end solution, most lenders only offer short-term or long-term financing, whereas Dynamo does both. I touched on that earlier with the DSCR product. So it's the fix and flip, and then they can transition or re-originate a new loan into a DSCR loan with Dynamo. Makes it really seamless for them. It creates a nice sticky relationship between the borrower and Dynamo, and it reduces the exit risk for them as well. Conservative underwriting practices. So the loans are structured up to 100% loan to cost, and they maintain a 75% loan to value, which protects the fund while still being extremely attractive to borrowers. And most loans actually have about at least a 10% borrower equity in the deal. They also have buyer loyalty. Nearly 50% of Dynamo's borrowers are repeat customers, and they have a 77% last lender use score, which means that when these investors need capital, they come back to Dynamo first. They share the origination fees. We said it before, but this is really unique to this market. That their biggest differentiator between them and other funds is that other lenders keep 100% of those origination fees or points, whereas they are sharing these with all the LPs or the investors, and that's what really drives these kind of returns. And that's how we're able to target a 16.8 to 18.9% return. While the other funds out there, if you've looked, they only usually return between a 9 and 13% return. And Dynamo's got a proven track record to prove this with a 32.68% return in 2024. I think those numbers speak for themselves. So can't complain about that. Now, I always like to start with the very basics. I know some of you probably watching this video are actually in the lending world. I know a few of Gina's lenders are probably watching this. But not everybody comes from that background, so we're just going to back it up just a little bit. So bear with me here and talk about some of the basics. Let's see. So a basic debt fund, some people who don't know, so let's make sure everyone's on the same page. Lending money is not new in the world of real estate and investing, and we're definitely not pioneers by any means. Lending has been around for hundreds, even thousands of years, so it's very common to have a one-on-one private lending. A fix and flipper who can't get a loan from a bank will go to a private person or an entity to get a loan. For a lot of real estate investors, that might be a rich uncle or aunt, someone they met out on the golf course or what have you, and just get a one-on-one private loan like that, or hard money loan. So, and this model is really simple, right? So the lender loans the money to the borrower, usually a flipper, and that borrower pays that back with the principal plus interest fees and probably some origination fees. And hopefully the lender is making 10, 20, maybe even 30% return on their loan. So it's a great model in theory, but here's the problem, right? So there's many people, this is why many people don't do it. One is if you've got a bunch of extra money, you don't necessarily, have the source there. So you don't have a bunch of borrowers lining up to borrow the money. You also have to underwrite these deals, which most people don't know how to do that properly. So, a debt fund does that for you. So to evaluate a flip or assess the ARV and do a proper underwriting, that's really a roadblock. You also don't have diversification when you do one-on-one lending like that. So you may have $100,000, $200,000 lent out to a flipper. But that's all in one project. It's tied up in just one, maybe even two projects. It's pretty high concentration risk if something goes wrong. And the last one, this is the biggest one, is really the foreclosure risk. So you lend money to somebody who's doing the foreclosure if this person doesn't pay the bill, right? So, I could see it now. You're texting them or calling them when they haven't made the payment and they're just ghosting you. So with a debt fund, that all gets handled. So just like with rental properties, someone's going to eventually not pay rent or destroy the property. It's just sort of not if, but when scenario in real estate. So with one-on-one private lending, you got to be aware of that could come down and somebody's got to deal with it. So that's sort of the issue there. So what's the solution to all these roadblocks that we talked about? Obviously a debt fund, which is what Dynamo Capital does. Debt funds have the expertise, the operational bandwidth to go out there and do all the heavy lifting for us. They source the loans, they underwrite the deals, they maintain and service those loans. And if the deal goes sideways and they need to foreclose, they can handle it. They hire all the right people to do that, to manage the loan, the legal process, etc. They take care of everything because really that's their business. That's what they do. And that's what Matt and Justin at Dynamo Capital do for 40 plus hours a week. So along with their entire team. So here's how it works, guys. Rather than you lending money directly to a flipper, you invest with a debt fund like Dynamo Capital. You as the private investor or LP invest your capital into the fund, and Dynamo Capital then goes out and issues loans to real estate borrowers. So in this example, a flipper who needs short-term financing to acquire and renovate a property, that flipper then pays Dynamo the interest, the fees, and the principal as they execute on their project and eventually exit the loan. So Dynamo does this. They collect all the revenue, the principal, the interest, and the origination fees, and then they distribute the profits back to the investor. Now, the great thing about this model, both as an investor and as someone who puts deals together like this, is we get amazing diversification. You're not putting all your eggs in one or two baskets with individual flippers. Instead, your capital is spread across multiple borrowers. That's pretty huge. So multiple loans, loan types. I think the portfolio is 80 plus loans. So those loans are diversified in multiple markets as well and over multiple different assets. So you get all of that without all of the operational headache and sourcing or underwriting and managing of the loans. So that's pretty slick. Now, as I mentioned earlier, I don't have the operational headaches of sourcing and underwriting the deals. I also don't have the financial concentration risk of having one or two loans representing a significant part of my investable assets. So with debt funds like Dynamo, you get diversification across four key dimensions. Multiple borrowers. So we talked about that. Your capital spread across dozens of different real estate investors, not just one or two. You also get multiple loan types. We talked about the fix and flip loans and the DSCR loans, but some of the stats are with Dynamo, they have 40% fix and flip loans, 35% are ground up construction loans, 15% are bridge loans, and 10% are DSCR long-term loans. So this mix provides stability. Different loan types perform differently in various market conditions, so you get that diversification. Now, looking at Dynamo's geographic distribution, you always also get that. So 65% of their loans are in Kansas, which is good. That's their home base, and they know that market really well. They have 15% in Missouri, 8% in Oklahoma, 7% in Texas, and 5% in other markets. So they're very strategic about this. So Kansas is their core market, but they've been expanding into adjacent Midwest markets where they have boots on the ground and deep market knowledge as well. the multiple assets. Every loan is secured by a different piece of real estate, so you're not betting on one single property or project. And Justin, can you speak a bit about how you think about diversification and concentration of risk as you manage the fund?
Yeah, so we're very cognizant about ensuring that we are never too concentrated in any one given product, any one given asset type, or any one given borrower, or any one given region. As you can see from our geographic distribution, we're heavily weighted in Kansas. Of course, Kansas is a home base. We know and understand this market very, very, very well, and so we're very comfortable with lending in this market. As we mentioned, we're traveling. We're increasing our geographic diversity, which will help to kind of spread that the diversification or the distribution amongst a variety of different markets. So we expect to reduce that over the coming months and year. And same thing on the loan type distribution. Right now it's pretty evenly distributed. I never expect our bridge loans to be our standalone bridge loans to be a high proportion of what we do. But fix and flip and ground up construction certainly are going to be much more market specific. There's a big housing shortage throughout the country, especially in Wichita. There's a lot of new homes that need to be built, and so we are seeing a little bit more of a shift towards the ground up construction market here in Wichita. Whereas maybe in some markets, the cost to build is maybe a limiting factor for a lot of builders and a lot of takeout buyers to take that on. And as our DSCR loan program starts to get a little bit more traction and smooth, we're building that operation out right now with Mark and his group. We expect that percentage to also increase as well. Although those loans don't end up living on our balance sheet, we do expect them to be a pretty sizable amount of our actual volume in a given year.
Now, I'd like to just go ahead and introduce you guys at this point. Now, I'd like to introduce you to the team behind Dynamo Capital. That's Justin McClough and Matthew Medrano. They are the co-founders and active managing partners of the firm. Justin and Matt both come from extensive lending backgrounds and saw a massive gap in the Midwest market for the kind of flexible and borrower-friendly capital that investors actually need to scale their businesses. So they started Dynamo Capital 2 years ago in 2023, and in just over 2 years, they've built to the highest performing private lending fund in Kansas. Justin and Matt, thank you for joining us today. Why don't you each give a quick background on yourselves and then walk everyone through how Dynamo operates?
Yeah, so started off in the financial planning sector right out of college. Very quickly made a transition into lending, residential mortgage lending, working with owner occupants, conventional FHA, Fannie Freddie, FHA, VA, USDA, all that good stuff. And slowly started to make a transition over to working with solely investor-based clients through a variety of different reasons and paths. We started having a bigger need for working with investor-based clients, whether it's flippers or builders or landlords looking to optimize their portfolio. And so over the years, started to transition more into that stage, and then started Dynamo Capital in 2023 with Mr. Medrano there, and we've been doing this for the last couple of years now.
Yeah, so I got into the lending space following a pretty decent career in the foundation and contracting space. So I worked with a bunch of property flippers here in Kansas. If anybody knows anything about Kansas, we have a ridiculously expansive clay soil, and I won't wax and wane about the engineering issues that causes in the homes in here. But we had a lot of foundation problems, and I worked with a lot of those clients, and I worked with a good base of real estate agents. I actually refinanced my house during COVID, as did everybody, and I did it with the guy in the window next to me, Justin. He also convinced me that rates would be 2% for the rest of the time and foreseeable future, and then I could lend in the Fannie Freddie world at 2% for the rest of my career. So I made the jump to come over and work with him, and obviously that didn't pan out the same way, but we had a really good relationship, and I had all these clients that were working with us from an investor perspective, a fix and flip perspective, but really no good products for us to give them that Fannie and Freddie provided. So we slowly started to get into that commercial space a little bit more with, bigger players that you would recognize, the Kiabis and the Lima Ones of the world. But ultimately, we found that we were getting passed over for bigger deals that those lenders had in, Texas and Florida and New York. And very quickly, we realized that the $75,000 cash out refinance that we had in Wichita, Kansas, didn't move the needle for them from a workflow perspective, and we ultimately wanted to serve our clients better. And luckily, Justin can crunch the numbers on how to start a fund, and we kind of fumbled into it, and now here we are with a much larger than we had ever anticipated fund that's doing very, very well with the help and partnership of Property Llama and investors alike.
Now let's dive into Dynamo's loan products and terms. Matt, do you mind walking us through what you offer borrowers?
Yep. So there's a couple of key metrics that with any lender, whether it's a private lender, a bank, a debt fund, et cetera, that you're going to want to pay attention to, especially in the short-term world. You're going to be looking at two variables that are loan to cost and loan to value. Those obviously spell themselves out for you. The loan to cost, or LTC, really what our calling card here is that we do 100% LTC loans, especially in the local markets that we're in. Loan to cost at 100% is very attractive to our borrowers, and it represents a lower risk than maybe 100% loan to cost in a New York or a more volatile market where the values of the properties really fluctuate. And then we also go up to 75% of the LTV. So that's what limits the risk associated with a high LTC loan, as an LTV that's capped around the 70-75 mark. I'd also point out that when we go through the loan tape later, you'll find that our book really isn't 100 LTC. While we advertise up to 100 LTC, most of our borrowers have about 10% skin in the game. So really our LTC is somewhere around the 90-92 mark. Justin will give you the exact stat when we get into it. But that's worth noting here. The interest rates are variable depending on the deal. We have different markets that we're in that have different interest rates that they are palatable to. So we blend a component of interest rate and points on the deal. So whether we're at 3 and 12 or 0 and 18, that's actually the same yield for us as the fund. It just depends on the market that we're in and what actually makes sense that the clients and borrowers want. And then we also tailor on that same way between 6 and 24 months on the loan terms. It just kind of depends on the market we're in and the asset type that we're working with. Shifting towards a long-term loan, the 30-year fixed product. We do fixed or ARMs. Most of those fixed pricing and fixed and ARM pricing is very, very similar at this point. So there's no point in giving anybody an ARM. We'd go with the fixed side of things. Pretty standard on how this DSCR long-term product looks. One of the more interesting things that we do, especially when cash flows are so decreased right now, is we have an interest-only option that Mark has really tailored and pioneered for a lot of our clients to make their cash flows make a little bit more sense given these harder rental times. So those are the two products. An ideal client for us uses us for the fix and flip on the acquisition side. And then instead of flipping, it actually just holds it and turns it into a long-term asset that we refinance for them. So what is very attractive about Dynamo is that we can do both, as opposed to being the hard money lender that does the acquisition and the rehab. And then you have to go source a local bank or a larger big box store lender to take you out into the long-term product. We will do both, and it's a very seamless, painless process, frankly, because we've already got all the work done on the front side. We just have it appraised and we refinance it, and Mark has a really easy deal for him to close up on that side. So it's should be white glove the whole way through as a borrower.
Now let's look at a real example. Matt, could you walk us through the Burr case study showing both your short-term and long-term financing?
Yep. So this is actually one of the first deals we ever did. It's for a local investor here in town. He bought this house on the top. These are actually the same houses, the before and after. He gave it a haircut and gave it a paint job, and all of a sudden we got a brand new house. So he purchased this thing for $144. You guys can read the stats on it. He put in about $48,000 worth of work on it. He actually, what was great for us was he didn't even touch the rehab budget for us. He just covered it in cash, which means that we charge fees against that. We never actually had to deploy those dollars, which is great from a cash flow efficiency perspective. And that spread, by the way, is real. That's what the Wichita market looks like. Everybody stay out of it. My borrowers here in Wichita are doing just fine on themselves. They don't need investments. Competitors coming out of Colorado and everywhere else trying to take these deals up. This is a real deal that we had. The asset was worth $280 when it was done. Ultimately, he needed to decide if he was going to hold it or flip it. He was originally intending to flip it, but he had somebody walk by the property. This is in a nice little artsy town. Part of town, and a borrower or a renter walked by and said, like, I love what you're doing here. Like, is this for rent? asked him for it. He decided to flip it into a long-term hold here. He wound up cashing out a good chunk of change. I don't know. Yeah, there you go. So net cash out of 159 or 159, 15.9. And he ultimately put in $0 into it because we put the on the funding side, on the front side, he didn't have to bring any cash to close from a purchase perspective, which was really good. He was able to pull out the cash that he had captured on that $16,000 and was able to ultimately scale his business even further. One of the reasons he went with us is because of the capital outlay at the beginning was so low. He had the opportunity and bandwidth to do other deals alongside. Ultimately, that's what Dynamo sells. We sell the ability to scale a portfolio and scale it fast, right? As opposed to having to tie up liquidity into each flip and each deal that you're doing. Use our dollars and our liquidity to do those flips and go out and expand your bandwidth. That's what we're really trying to sell. Dynamo really came to rise whenever everybody was becoming a landlord and wanted to get out of the rat race and kind of be their own property owner and flip the script. Post-COVID, the way to do that was brick by brick until you had something like a Dynamo, or again, we didn't reinvent the wheel, but locally, Dynamos really don't exist. And that's where we have a very great competitive advantage for our borrowers to come in and buy up as much property and scale as they quickly as they can. We will go as fast as that borrower can and just pour gas on the fire for them. That's really that's the whole strategy of Dynamo Capital.
Excellent. Now, one of the key advantages Dynamo has is the lack of competition in their markets. Matt, would you mind walking us through the liquidity void out there in the Midwest?
This is my favorite slide of the day. This was a creative choice we made here. This slide is absolutely representative of the liquidity in the Midwest market. When we mean by liquidity, we mean like institutional capital and institutional lenders that are providing capital to property investors and fixers and flippers in the Midwest. I always throw to Justin for this story. I know he's muted now, but he can come back in. We talked to one of the main purchasers in the country about purchasing our DSCR loans, and they keep about 18 months of inventory on their books. And over those 18 months of inventory, there were 6 loans, Justin? I mean, how much? Give them an idea of scale there and how little there is in the Midwest.
Yeah, so this particular buyer of whole loans, and they're just one of many buyers, but just for context, they buy $250 million a month, and they have about 18 months worth of inventory. So they have about $4.5 billion with a B dollars in their loan portfolio. And they had a grand total of 6 loans in Kansas, which I can't imagine account for more than $1 million worth of that $4.5 billion. So,
and all of which, if I remember right, we're in Kansas City, right? Not even in our neck of the woods down here.
Yeah, I don't recall that level of detail, but I'll take your word for it. But it's incredible that how the private lending markets can be so active on the coasts, but have such a void throughout the remainder of the Midwest. And we're here to fill that void, and we've successfully done so. I think there's a slide in here that shows our market share thus far. I'm not sure if it's the next one or another slide, but we have the highest level of market share in any state in the country, comparatively speaking. So Dynamo Capital, as of April, has 13.5% market share for the state of Kansas. This is through bona fide public record data, and that is the highest percentage of market share in any state in the country, which is tallest midget, I suppose. But we are absolutely dominating the Midwest right now. We were going to continue to do so.
What's impressive here isn't just the market share; it's the borrower loyalty. The repeat customers are really the gold standard in any business. Now, many of you may not be familiar with the Wichita market. Can you talk us through why this market is so attractive for real estate lending?
So I'm a Wichita native, born and bred here. So I went away for college, but that was it. I've been here ever since. And it really represents such a diverse economy. So we have, 2 of the largest private corporations in the country in Cargill and Coke that have major operations. So obviously Coke Industries is headquartered out of here. We've got, virtually every plane that's gone in the sky has come through Wichita, either on a shipping container or a component of it that's been built here or something along those lines, through your Spirits, your Raytheons, your Boeings. All those manufacturing plants are here. There's a significant healthcare system here. And so Wichita really has a beautiful blend of the wealthier property investors, while also having a healthy rental market of actual users of the properties. And it's attractive for real estate investors. When we were starting up in the commercial brokerage space before we started Dynamo, we saw a lot of activity from the California investors who were either getting out of California or moving to Texas or moving to here, and they were starting to see what the investment properties around here look like. But I mean, very realistic that you can buy a property that is a strong property for, you know, somewhere in the $60,000 to $120,000 range, and turn around then rent that for a very strong rental amount. I mean, I looked at a deal for a property along a client that came through in Denver, and they were buying what I would consider to be a $100,000 house in Wichita for $500,000 in Denver, and it still boggles my mind. And so that's just a good example of the scale difference between like a Wichita mid-tier market that Wichita is versus a Denver or a bigger major metro. So flips are still very attractive down here. BRRRR is a strong method that absolutely works here in Wichita. Ground up construction is nice and hot. We have a huge labor force that's ready to get going on that. And we're missing 50,000 units here in Wichita. Wichita is growing thanks to the exodus out of California and the western states coming over to the, you know, the Texas, and it seems like Texas is already full, so they're shipping everybody up to the OKC and the Wichita markets. We're getting a lot of traction on that. So there's a ton of housing need, and like we covered, there's really very little lending competition. Wichita is dominated by local credit unions and banks, who all have 2% money that's sitting on their books, and nobody's refinancing, and they're all overexposed. So we are virtually shooting fish in a barrel when it comes to the long-term takeout. And there's nobody that's really doing the local fix and flip stuff other than rich uncles and a few other smaller funds that are trying to jump in. And you can see this here, you know, and I would point out the mortgages for February to April are really indicative of where we're at here. If you followed along with anything with Dynamo Capital, we really slowed down originations and the sales component of our business so we could maximize our team and grow the DSCR channel with Mark, and really train up processors and servicers so that we were able to scale in an aggressive manner. So we had already really done a strong return coming into Q4 of last year. And so we took time to focus on bolstering the fund's capacity and build capacity so we could hit the ground running in 2025. And that's what we've done. So you can see here, given the other main lenders in town, our loan amount is almost half to 3 times the size of everybody else's. Our market share is obviously, it's a ridiculous number. Again, smallest midget, and it's an emerging market, so these numbers are probably a little bit skewed. Our whole investment strategy is high number of loans with low number of unique borrowers. We have a very low number of unique borrowers, which means that we know our borrowers very, very well, and they're coming back to us. I mean, 77% of those last lender use scores, which is pulled from a metric that the database that we're pulling this off of captures, is who used you last. We're at 77% on that, but almost 50% of our customers are repeat customers, which we love. And that loyalty customer score, forget what we got into on what the actual metric there was, but we're very proud of that 11%. That seemed to be a very difficult metric to get up. So Dynamo is not only targeting repeat customers, but we're actually proving that we have repeat customers for the amount of volume that we have here. So number 3, you can really see unique borrowers is very high, but they're not capturing that business again. And so we have really high, I guess that'd be essentially the net promoter score, effectively what we're looking at here. And we're pleased with what we've got here. So that's Dynamo and Wichita in a nutshell. That's a perfect marriage between the two.
Now let's address the elephant in the room here, the risk. Defaults and foreclosures, they happen in every lending business. Justin, would you walk us through how Dynamo defines and mitigates these risks?
Yeah, so we're very conscious in our servicing department of ensuring that we're touching clients as often as we possibly can. Not to the point of being annoying, obviously, but we're typically touching our clients at the very least once a month, and in many cases multiple times a month, to check in on the status of their projects, to see how things are going. We usually have a pretty good indication pretty early on if a deal is going to go sideways. And at that point, we can start taking steps to help that shift that performance to a more positive light. And so every case is very unique, right? And so there have been some cases where we see a deal going sideways, and we may ask if that borrower is looking to get out of the deal. If the answer is yes, we can always bring it to one of our many repeat clients and say, hey, we've got a deal that's going sideways internally. Would you like to take a look at this? And if it makes sense for you, take it on, right? We're able to shift that loan to a borrower that we know can perform, assuming that it's a borrower-led issue. If it's an asset issue, then it looks a little bit different, right? We have to look and see what that circumstance is at that point in time. Is it maybe that the asset is not priced correctly and the borrower is unwilling to accept a lower profit? Is it maybe the takeout's not there? What is actually causing a default scenario? And can we avoid actually going to foreclosure? Foreclosure is the last thing that we necessarily want. And so we take a lot of steps to ensure that we don't actually get there. So we almost always will offer a deed in lieu of foreclosure in the event that we have an understanding what the asset is. And if we have the ability to, if we feel comfortable maybe moving that asset a little bit more effectively than the borrower can, then we'll offer that to them, ensuring that we have enough collateral to make that make a level of sense. And if not, then we have to move forward with foreclosure, and it is what it is, right? It's not a matter of if, it's a matter of when. And we're okay with that. We have good counsel that steers us in the right direction, ensures that we get to the asset as quickly as possible, and our servicing staff is very focused on ensuring that we're in the loop at all times and getting through that process as quickly as possible to ensure that we can recycle that capital quickly.
So how does Dynamo get such high returns? That's the question everyone asks when they first see the numbers. How can we target a 16.8 to 18.9% return through this investment while most debt funds only give 9 to 12? So what's the difference? Well, we've said it before, but we're going to drive this one home, is that the answer is simple. It's actually my favorite part of the entire investment is that Dynamo shares more of the profits with the investors. The key differentiator being sharing the origination fees. That's really non-existent in other debt funds. And here's how a typical debt fund usually works. They charge borrowers interest on the loans, let's say 10 to 12%. They charge origination fees, usually 2 to 4% or points up front. And they keep 100% of those origination fees for themselves as GP compensation. They only share the interest income with investors, and so investors get a piece of that interest, but none of the fees. And after management fees and GP carry, you end up with about a 9 to 12% average return there on other debt funds. And so Dynamo does something completely different. They share that, both the origination fees and the interest income with investors. And this is how we're targeting a 16.8 to 18.9% net returns to you. So still significantly higher than typical debt funds. And why this matters? Well, same underwriting standards as the competitors. Nothing's changed. Dynamo is still doing, the same deals that other competitors are doing. They aren't doing anything that's riskier to those deals than anyone else. They just get higher returns. So no additional risk is taken. The loan structures, the loan to values, and the collateral requirements are all very conservative. They just simply share more of the revenue stream. So you're getting paid from both fees and interest, and not just interest alone, which is what other debt funds do. And we love this. This aligns everyone's incentive here, or their incentive with us, and everyone makes money from the same revenue sources. So the origination fee sharing model is why we can deliver such a high return at 16.8 to 18.9% target returns, while maintaining the same conservative risk profile as funds returning 9 to 12%. So that's pretty impressive. All right, so before we jump into the fund economics, I wanted to touch on the fund audits. So on September 23rd and 24th of 2025, Gina and several other fund managers flew out to Wichita to do an audit of Dynamo. So they did a randomized audit of their loan tapes and underwriting guidelines and checklists, as well as pulling titles on random loans. And Dynamo also does third-party accounting and regulatory audit annually. Just wanted to add that in there. I know that question is going to come up. Okay, so let's take a look at the investor return summary. We've structured attractive return tiers based on your investment size, and the investment structure is as follows. So 100,000 to 250,000, you get a targeted return of 16.8% 8% annual return. 250,000 and above is a targeted 18.9% annual return. Let me show you what this means in real dollars here. So the example, $250,000 investment at 18.9% targeted return, that's approximately $47,250 in annual cash distributions. So you compare that to a typical debt fund in the market that only returns 9 to 12%. That same $250,000 in a standard debt fund would generate about $22,500 to $30,000 annually. So you're looking at a significantly higher cash flow in this investment. $100,000 example is at 16.8% targeted return. That's approximately $16,800 in annual cash distributions. So still substantially higher than the 9 to 12% you'd see from a comparable debt fund investment. So these are strong market leading returns for this asset class, and you're receiving monthly distributions that you can either take as cash, you can reinvest it, or do a combination of both, which is what I really love. Lots of flexibility there to change it up. Okay, so a question we get all the time. Can I just invest directly with Dynamo Capital? And well, the short answer is probably not. Dynamo Capital's direct investment requirements are pretty straightforward. Their minimum investment now has moved to $1 million or more. They focus primarily on institutional capital and ultra high net worth investors. So if you're an individual accredited investor with less than $1 million to deploy into this single investment, they just simply, don't accept smaller investors. So there's just back office, with that. There's costs involved with that, regulatory stuff that they have to deal with, and they would just rather take several large checks than, a couple hundred people, depositing $10,000 at a time. So that's where we come in, and that's what the VY Capital Fund is all about. So it's not unusual for institutional funds, but it does create an access problem for most accredited investors who want exposure to this opportunity. So a little bit of the backstory, how Gina and I got here is we originally invested with Dynamo through a pooled investment vehicle, very similar to this one. And we saw the great returns and understood the business model. And we were very impressed by the market opportunity and the team there at Dynamo Capital. We started sharing this opportunity with friends and colleagues, and a lot of people came back and said that they wanted to do it too, and they wanted to invest alongside us. And so that's really how we ended up here. The demand was significant enough, so we decided to go ahead and create our own pooled vehicle specifically for our investor community and people we know. And so this structure allows us to aggregate capital from multiple investors and provide access at only $100,000 minimum. And that's, instead of the $1 million minimum, that's 90% lower than Dynamo's direct investment requirements. So the bottom line, you get an institutional quality underwriting, market leading returns, and professional fund management without needing to write a 7-figure check. So that's a big advantage. All right. So now if you're interested in this opportunity and want to learn more, so here's the next steps. So first, visit our data room. We've built out a comprehensive knowledge base with everything you need to do your due diligence in the data room or the deal room. You'll find detailed information about the fund structure, answers to frequently asked questions about risk management, the returns, and how the investment works. We're going to have a return calculator set up so you can model out what your specific investment would generate in cash flow. And we'll send the data room link to everyone right after these presentations. So look for that in your email. And second, understand the investment timeline. So you guys, here's how the process works. If you do decide to invest, capital is called on the third week of the month. So for example, if you're investing in November, we call capital around November 21st. That capital is then deployed into Dynamo's capital fund on the first of the following month. So in this example, December 1st, your money is deployed on that date and it's immediately earning returns. So your first monthly distribution is sent by the end of the following month. So continuing this example, you'd receive your first distribution in January 31st. So from that point forward, you'll receive monthly distributions every month for as long as you remain invested in the fund. And finally, and this is important, monthly allocations. So they typically fill up every month, and what this means is that, like Dynamo, if we showed up with $10 million and they only have $5 million in loans that they're trying to fund that month, that would create excess capital, and they don't want to take on that excess capital and start paying you a return on it. So they kind of have an allocation every month, looking at their pipeline on what they're going to take, and so those fill up every month. So if you're interested, you kind of got to jump in and let us know, and we coordinate with them to match our investor capital calls with their needs. So this means spots are going to be limited every month. So if you're interested, contact me directly or Gina, and we'll have the soft commit form. There'll be links in the deal room or data room for the soft commit form. We'll also probably send that in the email to reserve your spot. If you have any questions about the fund, the timeline, the process, anything, please feel free to reach out to Gina or myself. We're here to help you guys understand the opportunity and determine if this is right for your portfolio. So I want to say thank you all today for joining us, and we look forward to having you guys join us in the investment. Matt and Justin, thanks again for joining us today. We'll see you guys.